Welcome to the Skillick Explains video, and welcome to number 3 in my Key Terms for Share Investors series. And the key term this time is working capital cycles. Now, why are we doing this series? Well, in a tougher climate, by tougher I mean inflation on the rise, interest rates on the rise, maybe they've peaked, maybe they haven't, China under pressure, one of the engines of the global economy, as I make this in 2023, a war on, all these factors are making the backdrop trickier for companies. So investors need to be alert to certain key pieces of jargon that can flag trouble. Video 1 was one of them, operating leverage, the relationship between fixed and total costs. Video 2 was financial leverage, interest-bearing debt to equity. This one is the not too glamorous but vital working capital cycle. Now, poor working capital management can hammer cash flow and can actually break firms that are otherwise making sales and otherwise profitable. Well, let's take a little example just to show you what I mean by this. A little snapshot, slightly artificial example, but to make the point. Imagine you're growing a business. It sells £100 million worth of kit over a certain period. 3/4 of those sales are on credit because we're trying to attract customers. So we're not demanding cash immediately, we're selling and giving them time to pay. On the other side of the coin, because we're trying to grow a business, purchases are 80 million, got to buy something to sell. So we're buying 80 million, marking it up to 100 to sell it. But this time, because we're trying to grow a business, let's say that only 25% of those purchases are on credit, or 3/4 are for cash. Now, I've made that example a little bit extreme to make a point, which is over that one period, that one window period, the net cash outflow would be what? Well, if 3/4 of our sales are on credit, we'll only be collecting 25 million, if you think about it right now. And if we're having to pay 3/4 of our purchases for cash, that's 60 million going out. 25 coming in from selling stuff, 60 million going out from buying stuff, gives you a cash flow negative 35 million. But wait a minute, you are making profits. Sales 100 million, purchases 80 million is 20 million of profits in the profit and loss account. Happy days there. But because of the way the business manages its relationships with customers and suppliers, the net cash outflow is 35 million. So you're making profits, but going bust. Now you might say, yeah, but next period it'll all change, Tim. Maybe, but it makes the point. You can't carry on running a business that's draining cash, even if it's selling stuff and making profits. So here comes the working capital cycle, or the operating capital cycle, if you like. And it's a quick snapshot on the extent to which businesses hoover up cash, if you like, or generate it. I'll come back to that final point in a moment. And it comprises what's called stock turn plus debtor days minus creditor days. In other words, it looks at the length of time between, if you like, paying for stock and getting it out the door to customers. Adds on how long customers take to pay us on average, because we've got to fund all of that period until cash comes back in the door, minus creditor days, because that's the other way around. That is the length of time we take to pay our suppliers, hence the first example. So to put it another way, the longer you have to hold on to stock on average as a number of days, and the longer it takes your customers to actually cough up the cash they owe you, okay, the worse off you are. But that's offset if you can take your time paying your creditors for the stock you're buying. So here's an example. Imagine a business sits on stock before shifting it to a customer for around 50 days. That's called stock days. Imagine on average, customers then take 90 days to pay. How do I get that? 3 months, not untypical. But on the flip side, we don't pay our suppliers for anything for 60 days, 2 months. The working capital cycle, as it's known, is 80 days. 50 plus 90 minus 60, or 80 days. So what? What does that tell me? That tells me that on average for this business, there's an 80-day gap between cash leaving and cash coming back in again. And that's got to be financed. Yeah, that gap is a consequence of running a business with customers and suppliers, but it's got to be financed somehow. And what you don't want to see is businesses using long-term finance to fund that short-term working capital problem, and they do sometimes. And if you're thinking, what sectors are you talking about here, Tim, where there's an 80-day gap between basically cash going out the door and cash coming back in again, the working capital cycle, think manufacturing, heavy engineering, it might even be longer than that, okay? Now, just to turn that around, there are businesses out there where the working capital cycle is negative, happy days. That implies that cash actually comes in the door before we ever have to pay a supplier. Brilliant. And if you're thinking, what model would that be? Think about food retailers. Think about their model. Cash comes through the till from customers before they have to pay the suppliers who sent it to them. Now that's happy days. That's an unusual business model. That's not a normal business model, but that's fantastic. And there, the questions you'll be asking are not around how do you fund the working capital cycle, because cash is washing through the door. It's more like, what are they doing with all this cash? Where are they investing it? Are they paying dividends? And so on. So, going back to a standard working capital cycle where a business basically needs to fund the gap between cash leaving and cash coming in again in operating terms, what are we going to look for? We're going to look for its length against recent history. What we don't want to see is that working capital cycle stretching as businesses come under commercial pressure. Right, we're going to look at the peer group. We're going to look at the wider sector. You know, it's all very well saying one company's got a working capital cycle of 80 days, but so what? How does that compare to peer group? How does that compare to the wider market? Other sectors? What are our expectations? So what is the direction of travel? Are management controlling the working capital cycle, bringing it down, okay? Or is it stretching, in which case, go back to that question, how are they funding it? So management experience is vital when it comes to this working capital management. All right, there's a snapshot. To find out more, killick.com/learn has my videos down through the usual tabs. I've got a guide, How to Invest in Equities, which covers a little bit of this stuff. It's light blue, and that's editor@killick.com. And you will see this kind of jargon mentioned in Confidant, particularly by the equity research team. So for a copy of that quarterly, editor@killick.com.